Hi, my name's Ray Fuentes. I am the Red Shoe Broker, and today we are going to talk about eliminating debt with Carrie Hagensmith. But before we get started, a couple of pieces of information I have to provide. My name and my license number, you'll see that on the screen. You can reach me at 916-919-1377. I'm on Facebook, LinkedIn, Twitter, and YouTube. Hi, Carrie, how are you?
Doing great today, Ray. Thank you so much.
Yeah. So Carrie and I got into a conversation about how people have debt and how they can possibly eliminate debt. And I shared a story with you yesterday regarding me teaching seventh grade. I used to be a seventh grade math teacher. And one of the classes that I taught had to do with percents. So if you're teaching your kids at home and you're trying to figure out how to go over percents, this is what I did. I took the idea of a credit card. I was not just wanting to teach math, but a life lesson. And so what I did was I gave each kid a fake credit card for $2,000, told them to go out and buy whatever they wanted. It wasn't a real credit card. And what they bought, really, they just did like a dream board. They just took pictures and a list of things that they wanted, how much it would cost, including taxes, up to $2,000. And that was fun for them. They bought clothes and, CD players and all that stuff. And then we came to the fun part, which was, okay, now you have to pay it off. And the minimum amount is $20 a month. So you have a $2,000 debt on your credit card. Let's go ahead and pay it off. And let me remind you, they had to do this by hand. They couldn't use computers. This was a very long time ago. And they started the $2,000, they paid off 20 bucks, and then they had to add the interest. After everything was said and done, I asked, how long do you think it's gonna take to pay it off? And they didn't think about interest. They figured 2,000 divided by 20, 100 months, which is a lot, but that's what they thought. Once they started working on it, they found out it was going to take much, much longer. In fact, it took about 20 years, and the total amount they paid was about twice as much. So whatever they bought at that date, 20 years later, they had paid $4,000. And if you bought clothes 20 years ago, they probably don't fit you anymore. So the best part of all this is we stuck all this information up on the wall. It was parents' night. Some parents came in. The kids were telling about their boards and what they found out and what they learned. I did have one spreadsheet done on Excel that showed how the process worked. Why did it take 20 years? And how did it become about $4,000? A parent came up to me and said, "Is this right?" I said, "Yeah, absolutely." And he goes, "Wow, I have 3 credit cards almost maxed out. It's about $6,000. It's going to take me 20 years to pay them off." I said, "Maybe." Now this was a long time ago. I was teaching in 1995 or 96, something like that, quite some time ago, before I became a realtor. And I did know one method to help people reduce their debt, and it's called debt snowballing. That's what I shared with the guy. Well, what you do is you take the smallest credit card, the one that has the lowest limit, not the interest rate, but the lowest limit, or the amount of debt on it, and you pay that off, and then you take the money from that one and pay the next one off, and you go over and over and over again. So that's how one of our conversations that I had with Carrie. Carrie, what do you think about that?
It's working for some people. It's not mathematically correct every time by a long shot. It's not the mathematical solution, but it is an emotional solution. And it's something people can see. They don't need spreadsheets to make it happen. And that's the beauty of it.
Yeah, I didn't think that was the fastest way, but I do see that, after a few months, putting all your money towards one credit card, I mean, you're still paying the minimum on the others, but, they could see it chipping away. It was very easy to see that.
Yeah, it's very rewarding.
Yeah. I didn't think that was the best way. I just had a gut feeling that that wasn't the fastest way. So I took my spreadsheet and I compared what happens if you paid off the lowest amount versus the highest interest or the lowest interest or whatever. And it turns out, while debt snowballing is an emotional process and it does work, it actually takes longer than if you were to pay off the highest interest rate first. So whatever cards or whatever debt you have at the highest interest rate, you pay those off first, and it works faster. And I didn't know what that was called, but Carrie, you enlightened us to that. Tell us a little bit about.
Yeah, we're going to go through that. We have a slide that'll show that in a little bit, all the options that people have. One of the places I often start, though, is the mindset of debt, just what you talked about with your parent, right? The mindset of debt is, it's not a big deal. I mean, I'm making I'll pay $20 a month, or my mortgage is, $2,500. I can do this. It's an easy thing. So the biggest challenge is we have such a mindset that debt is fine. I mean, let's face it, our country's in debt. So we feel like debt's normal. And we have actually handed over all of our responsibility to the banks to be our watchdog for our money.
We trust
I'm sorry. That's really the wolf in the, the coyote in the hen house?
Chicken house, yeah.
I mean, that just is insane what we've allowed. And I've been guilty, believe me. That's why I got so excited when I was introduced to Debt Shredder, working it on and using it, as a business, because I think it is completely amazing what is possible when you're actually using algorithmic math as opposed to my spreadsheets or actually doing auto pay. So the mindset is really the biggest thing. Let's face it, borrowing gives us opportunities. We get to have what we want or even what we need right now. So nobody's saying you shouldn't borrow. That's not really the point. Yes, there are ways to become your own bank. That's a whole other podcast for you and guest. But it's not the worst thing in the world. It's just the beginning of the opportunity. The second opportunity is paying it off, and we don't see that as an opportunity of how we get rid of the debt. So let's just take a look at a slide that shows how our country is in debt.
Before we do,
don't switch me over. You just go ahead.
Okay. As a realtor that was doing real estate in the early 2000s, all the way to 2007, 2008, I was involved in that. It was very interesting to see that, because I heard lenders talk about it all the time. Home prices are up 20%. And I even heard an ad on the radio yesterday. Why don't you go ahead, take out a loan? Interest rates are so low. Take out a loan and buy a new car, pay off some debt. And I'm like, whoa, hold on a second. That's what caused the problem last time.
Yes, it is.
Right? So if you're watching this, whether it's live or a recording, please be very, very careful if you're going to be using your house as a bank. Make sure you truly understand the impact of that. You can call me or call Carrie. Carrie will give you her phone number.
We'll have an example of that right now that'll help you understand why take a second look at that instead of just thinking that's a great idea.
Okay.
But here's the next slide that we have is really all about our country and debt, right? We are a debt-fueled economy. Credit card debt average, and this is across the country, so in our area it could be significantly higher, $16,000. Add to that a $202,000 home mortgage, $50,000 average student loan. That's really not what I'm hearing. And the average car loan is just under $32,000. That's a lot of debt to be in. And it's very interesting, Ray, when I talk to people about debt and they go, oh, we don't have any debt. And I say, congratulations, you paid off your house. They go, oh, well, no, we still have a mortgage.
Right.
I don't know why, but in our brain, a mortgage doesn't seem like debt.
Yeah.
I don't understand that anymore, but I did before. That's great, because that's a necessary. That's a given. No big deal, right? That's why we have our house. That's great. But let's take a look at how it's just crazy. The next slide shows that.
I'm sorry. I used to tell people that, I said, you're going to be a homeowner. And they go, yeah. I said, yeah, you and the bank. I wanted to make it very clear to them that it's not their, they don't own the house outright until they have that deed. And they don't really get the deed until it's all paid off.
Till they do the deed of the debt.
Right.
Right. Oh,
Did I go to the right screen?
interesting. Well, if you'll back up for just a second, I'll just, yes, that is what we want to do. You were right. You've got the right one up. Here's what I want to show you, and why. When somebody said to me, we even have a slide that shows this, 34.5 cents of every dollar in the country is spent on interest. I said, well, that's crazy. I don't have a 34.5% interest rate on anything. I mean, we're coming close on some things, but that just doesn't make sense. Let me show you how it makes sense.
Okay.
It actually does, but I didn't get it. So that first, if you'll just arrow back up for a quick sec. So there we go. You have a 30-year mortgage. Yeah, you're right there. We have a 30-year mortgage on a $200,000 loan. It's at 4.5%, still pretty good at this point, but just as an example, we wanted to make it round and easy, right? So you have a $1,013 that you pay in your monthly mortgage. So the next click shows you.
Oops, I went backwards. There we go.
That's okay. The first year, 73% of that went to interest. So 8,000. I guess
8,934.
And 34. Like, there we go. Went to interest that first year. The second year it gets better. Instead of 73%, as you click forward, it'll be only 72% goes to interest.
You know, that's funny because one of the things I taught, again, as a realtor, I transfer the information about loans over to the lender. I let the lender address those specific questions. But I tell people that in your first year, you have 73%. I actually have it a little higher because it's I round it off to 75 or 80%. So if you pay, for example, in this example, the $1,000 roughly a month that you're paying, $750, $800 goes to interest. That only leaves $250, $200 going towards the principal. It's crazy.
It's crazy. The next click will show you what happens at year 20 in this 30-year scenario. At year 20, you have paid $243,000 on your on your 30-year mortgage that you only borrowed $200, and the next click shows you how much you still owe.
So you didn't pay off your house, even though you paid $243,000.
Exactly. You still owe almost half, $97,000 at year 20.
Yeah.
So then the next slide shows you what your total interest is. That in 30 years, you've paid $365,000 on this house. So $165,000 of it was interest. Here's the challenge. We think of the interest on our house at 4.5% is wonderful, but it's actually in simple interest, 82%. Click the next arrow. It's 82% in simple interest that you have paid. This is why 34.5% of every dollar goes to interest, because we don't realize where it's really going. They've hidden it beautifully.
And that's, so we're talking about simple interest. If it were simple interest, obviously it's not. Compound interest can be our friend or our enemy. When we're paying it, it's our enemy. And I think it was Albert Einstein that said it's so above what we normally can imagine that he had difficulty understanding. I think it was him, right? Did you ever hear that one?
No.
Yeah, I think it was Albert Einstein that said compounding interest is confusing. It doesn't work the way we think it does normally. For the average American, it is truly a confusing concept. It's not.
Why do we think that is?
Oh my gosh, it's the benefit of, in this case, banks and investors.
Correct.
And that's how they make money. I'm all for people making money.
I am too.
Right? But I think if we can take advantage of reducing the amount we pay, they're still getting paid. I'm just using I'm just going to go back to the debt snowballing. If you use the idea of debt snowballing, I'm just using part of what they do to make to pay them less. Right. I'm just using their tools against them. And I understand your tool, but your product, Debt Shredders, is actually head and shoulders above what we were talking about earlier with snowballing and avalanching, I think it is.
Right. Well, I know we don't have much time on here, so I'm going to whiz through a couple slides
Sure.
that'll show that's different. So if you'll just forward for us, I said that about the 34.5 cents. The next one will give you a bit of an idea of why people fail to reach their goal of financial freedom.
Yeah.
And it's me too. My husband and I, we look at each other and we said, we're really kind of smart. What the heck? How come we didn't see how this really worked? The problem most of us have in life is that we're generally comfortable enough and busy enough that changing something in our lives is easy to avoid. When it comes to making wise financial decisions, we generally take the easiest path, not the best path. And, I call it the ostrich effect. Ostriches don't really bury their head in the sand. They just lay it on top. But from a distance, it looks like it's buried in the sand. It's just us people that dig a hole, stick our head in it, and invite everybody else to throw the sand over, right? So the next slide will give us at least an idea of what's possible. Here are the options that many of us think of. Just go ahead and click them through so that we can get them all up there. Pay the minimum payment.
Yeah. The biweekly one is something I share with my clients. Hey, talk to your lender. Yeah.
Hey, one payment a year is still one payment a year. That's awesome if it helps people think that way. Refinance or debt consolidation, that kind of scares me. Mm-hmm. And not that you shouldn't do it. My point is that most people don't know what they're doing. Right. Because they think that because the cost of doing this is rolled into the new debt, we don't realize it could be $4,500 it's costing us to refinance. The debt consolidation, I had one friend was $13,000. It was thousands of dollars. So we just don't really know the real money going out. You can make more money. Some of us know how to, some of us don't, right? Send extra money to principal. Here's the real key. This sounds easy, and it can be. I have a lot of people when I do their analysis, I say, okay, I know what you're paying, but what's your minimum payment? They go, well, I pay $200. And I go, yes, but what's the minimum? Well, it's $180. Great. So you're sending $20 extra. So we have $20 to work with. And that happens across the board on most of their debt. We'll show how that adds up and can make a big difference. We talked about this debt snowball. The debt avalanche is the next one. And that's an option.
Oh, those
are all great options. But here's the question. Which one do you choose? So go ahead and click down and let's talk about what it looks like really. This is our second strategy in our software is strategic payoff. So here's an average kind of person's debt. They've got 6 debts. Excuse me. How many do I have there? 1, 2, 3, 4. There's 5 on. Oh, the 6th one. There's the car. It's behind your face on my screen. So they've got 6 debts. Where do you put that extra money? So if you're throwing $20 a piece and it's now you got $120 to play with, do you put it $20 to each one? Do you put 1 month, one more? Do you put it to the lowest, the highest, the what? We're all throwing darts and guessing. So if you click the next slide, what it shows is through factorial math, there are 720 permutations or possibilities for the ways that this money could be moved in 6 accounts. Factorial math just says 6 times 5 times 4 times 3 times 2, times the 1. All of that shows the actual number of ways that all of this could be moved, changed, paid, whatever, through those 6 accounts. We think we know what we're doing, and then we look at that number and say, oh, no wonder I need an algorithmic program that's already been programmed with all of the bank's algorithms, but now using them in my favor? You bet. And the next slide gives us a chance to see a little something.
There we go.
Oh, ours is the GPS. Go ahead and click through. It's amazing that it is in real time and you get to put scenarios in whatever you'd like. I wanted to show you a quick example. This is actually a customer of ours. He had, 2 mortgages, 4 credit cards, 6 total debts, totaling $566,000 and change.
Right.
The thing I want to point out here on this report, this is our free analysis, specifically for this scenario. We said his monthly discretionary income was 0. In this report that I'm going to show you, 0 extra dollars were put towards these bills. 0. And every time I get to the end of it, everybody says, so where's the extra money come from? And I have
We
to
didn't
go,
have to stop paying for Starbucks or whatever.
no, this is not change your life. This is not the rice and beans version. As you've heard me say this before, but I call this the no debt reduction. And it is no new loan, no consolidation, no rice and beans life, and no more guessing.
I happen to like rice and beans.
Pardon?
I happen to like rice and beans.
Yeah, me too. Go ahead. So what we have here is on the left side, you'll see the red shows where the bank is heading him. If for his $650 whatever $1,000, $655,000, $653, he's going to be paying a total of $970,910. The bank version. He will be out in 28.8 years. You move over to the debt shredder version.
I'm sorry. So I just want to clarify. So he'll be done in 28 years. So obviously he was already, this isn't a new homeowner.
Well, he's not a new homeowner, and he actually has 2 mortgages. He had just taken out a second when this analysis was done for him.
Okay.
Yeah.
All right.
He had just taken out a second on his house, so put him back into 28.8 years. Okay?
Oh my gosh. So he was lower than 28 years with the loan, with the mortgage?
With the original.
See, and that's exactly, I'm sorry to interrupt, but that's exactly what happened in the mid 2000s, 2004, 5, 6, 7, and 8. People were taking out a second on their house, and they were buying cars, they were buying boats, they were, I'm going to pay off my credit card, which was at a higher interest rate, so it must be better to be on my mortgage, plus the interest is a tax write-off. Yeah, and people did that year after year after year. You can see it. You can see it in their tax records.
I know.
Oh my God!
And it's we did it. We did it back then. I didn't know. We did it, and yeah, it made it more manageable. But that's not what really happens. So anyway, in the blue, it shows, and I like to show time before money, and the reason is, how amazing is it that you could be out of debt in 13.6 years? What if you saved no more money, but you were out in 13.6 years? How amazing would that be? That feels really good. But the amazing part is there was no extra money every month put towards the bills. And in the upper right, you can say he will save $216,000, $618. Amazing.
I don't know how old this guy is, but for me, I'm 57. If I had to wait 26 more years, I would be 57, 77. I'd be 84 years old here versus 11 years. I'll only be 68.
Right. So he has 15.2 years of debt freeness to use. The next, well, here's the interesting. And we're going to show you what he could use it for. The interesting thing is every month they wait to use the program, they're throwing away $1,329. Not actual cash now, but throwing it away over
because
time.
Of the savings.
Because of the savings. They're giving the bank, they're tipping the bank $1,329 every month. The next slide shows what we talk about in the build wealth side. So if you look along there on the left side, so from today to 28.8 years, he's got that length of time to get himself to have all of this debt, or especially the longest debt, right?
Right.
That's if they don't get themselves into debt anywhere along year 5, year 20, year 27, if they don't get any more debt. Just in 5 years alone, he's saved $79,000 just in 5 years alone. So here's what happened. When he got down to the 13.2 years, now he's out of debt. If he uses the exact same amount of money and puts it in a vehicle that would give him a 1% return. Well, you and I both know people that can guarantee a 4% right now.
Absolutely.
But a 1% return, he will have at the bottom there, it shows almost $1 million in the bank. Same amount of money out of his pocket, allocated differently. And that's what our program does. It every week you go in and it'll tell you exactly what to do. If you'll flip through to the next one, we'll just wrap this up real quickly. I want to.
So this is your program. I'm sorry. Is it a computer program? Is it an online service, or how does this work?
It's an online software that you own for life, and it's a complete education program. Fabulous money manager, and it has coaching on the other end as well.
Okay, I probably jumped ahead. I'm sorry.
That's okay. Good. I love your questions. Go ahead and do them all, and I'll just read them.
Okay,
we employ 4 strategies: interest cancellation, strategic payoff, which I showed you, right? The factorial math, which one do you choose? Time value of money, that we make sure, of course, that you have more money now because it's not going to be worth as much if we leave it for you to later, and our coaching and education system. Go ahead and click through, and I've said this already. Go ahead and click to the next one. I really want to show you what the software is telling you to do. How much money to move? Go ahead.
I'm going to move my picture.
Good. Exact dollar amount to move. Exactly what date to move it. And you and I were having this conversation yesterday that the date matters. The date matters. The bank's using your money for 14 days and investing it and making money on it before it applies to your account if you're paying it on the 1st. But the date matters to a lot of things. So the exact date, from what account to what account. We could take a piece of it from a credit card. I don't know what it's going to do for you, but it could take a piece of it from a credit card that is not accruing any interest for 2 weeks. Put it over here, pay this, take it from a different account, pay the credit card back, all the same money, but moved differently to cancel interest. I call us Pac-Man for interest.
So one of the challenges that I know homeowners have is my mortgage payment is due on the 1st. So I got to make sure I send it in time for them to get it on the 1st. And sometimes they even do it online and they have it they submit it on the 30th.
Yep.
Even before it's due, because we're so ingrained that, if we're 1 day late, it's a problem. But what I hear you saying, and I happen to know this, but just for everybody else, if you don't pay it on the 1st, no one's going to know. Is that true?
Well, it all depends. And I know I work with Tracy Ferris's program. She talks about, debt, how debt really works against you and so forth. And so the date does matter. And it matters because every bank is a little bit different. Usually they say it's due on the 1st. They're not going to make you late until the 14th or 15th. But they've got 15 days of your money. I won't tell you the exact date because every company is different. She always suggests calling absolutely every company that you are with, what date they report on, because as a mortgage person working with realtors, she wants to help you make sure that your credit rating is up, right? And so making sure that you know exactly what date they actually report on is also a different thing. But it's really fascinating. There's so much more to tell. And the most important thing is the next slide just invites you to get your own free analysis. It doesn't cost anything. I am happy to do it for you and see if Debt Shredder can help you. We never know.
Absolutely.
And I've worked with people as little as $50,000 in debt. They decided to consolidate. They went through a consolidator. It's cost them a lot of money. Then she found out what I was doing. And so it's a friend of mine, and she gave me all of the financial information prior to going to the consolidator. And I would have had them out with the money they already had in 2.5 years. They were done. Done.
So some people don't know what a debt consolidator is, and we're kind of out of time, not really out of time. I scheduled 30 minutes. But if you have another minute, can you explain the challenge with debt consolidators? I mean, they certainly have a benefit, but they
do have a benefit. I understand it. And when we get into that situation, everybody has it's panic, and I get that. So that may be the only way that you can pull this off. And I understand that panic feeling. But just understand the math, understand what's happening, understand what it can do to your credit rating, depending on what they've negotiated, how they've negotiated it. I mean, when you do a negotiated pay, it can show on your record. So those are the things to look for and make sure about.
And that's what a debt consolidator does. So you have, I don't know, you're paying $100 a month in credit card debt, for example, 5 credit cards, $20 each one, the minimum amount. Right. And the consolidator, what they do is they contact each credit card and they say, hey, we're going to help you pay this off. And what they do is they take a piece of the pie. They take some money out of that you could be applying towards your credit card. So even Dave Ramsey, the financial guru, recommends you do the negotiations yourself and not use a debt consolidator and applying that extra bit of money. And this is also a good point, if you don't mind me, over the past month or so, because we've been in the shelter in place, coronavirus, COVID-19, whatever you want to call it, the government has come out and said, hey, there's, let's go ahead and help people with the idea of forbearance with their mortgage. And so if you don't, this is another 30-minute conversation, but forbearance is not forgiveness, right? Forbearance means you're not going to make your payment. There's different ways to do forbearance, but one way is you're not going to make your payment for 3 months, your mortgage payment for 3 months, and on month 4, you're going to do all 4 months at once. And if you can't make the mortgage payment now, how are you going to make all 4 payments later? Plus, it could potentially have a negative impact on your credit score. Who wants that? There is another type of forbearance. There's different types. I don't want to go into them, but before you go into forbearance, I recommend you give somebody a call. Call me. I'll be happy to talk to you about it. Call Carrie. Her number's here, 916-792-8897, or email us. You can see Carrie's email at the bottom. Mine's ray@rayfuentes.com. Carrie, any last tips for those of us in debt?
Just remember that debt's an opportunity. It's an opportunity to know how to eliminate it.
Yeah, it's all about education. I agree. So thank you much for your time. I appreciate it. My name is Ray Fuentes. I'm the Red Shoe Broker. We'll see you next week. Broker Ray out.
Thank you, Ray. Thank you, Carrie.
Thank you. I'm cutting stuff.